Good Friday evening, everybody, and welcome to Fonti International. I'm Alexandra Georgieva, and we're going to be together for the following 1 hour and a half. So good so far for the U.S. indices, hitting new all-time record highs. S&P 500, 3,242 points. Dow as well, 28,684 points. And Nasdaq pretty flat, but have a look at it above the 9,000 level. This is all-time, historic, all-time record highs. We're going to be back on the markets, but first of all, very quick look at the major headlines. The tech-heavy Nasdaq about to close the year, topping the historic 9,000 mark, lifted by a jump in Amazon shares on a record holiday shopping season. China warns the European Union not to implement protectionist policies if Brussels enacts tariffs. Consequences will be catastrophic. European Commission President Ursula von der Leyen voices her concern about Brexit. 1 year of negotiations could not be enough to hammer out an effective agreement between the two parties. U.S. electric vehicle maker Tesla began delivering Model 3 vehicles built at its Shanghai factory on Monday. The stock is hitting all-time record highs. One intense years on the markets draws to a close. At Fonti International, we will analyze the winners and the losers of 2019 and what to expect from 2020. So big show ahead of us. Stick around, guys. But I just want to have, once again, very quick look at the U.S. averages. Have a look at them. All of them hitting all-time record highs, despite the fact that they're slightly lower this evening. S&P 500, 0.1% higher. Dow as well, a little bit more than 0.2% higher. Nasdaq a little bit flat, but still 9,014 points. The VIX index low at a 13.34 level, still 5.45% higher. And the FANGs mostly mixed, but have a look at Apple. Great year for Apple, higher by 80% for 2019. The other stocks to watch that we're going to talk about this evening is certainly Tesla. Have a look at it, $430 per share. And this is complete record about a stock. There is a lot going on around Tesla, and we're going to discuss it a little bit later on the show. But first of all, let me also show you the bond market. The U.S. 10-year Treasury is yielding 1.87, the 2-year 1.59, and the 3-month 1.57. As we can see this evening, we are witnessing slightly lower Treasury yields compared to the last live we had together. I want to show you very quickly also the Forex, the dollar index 96.98, lower by 0.6%, euro dollar 1.11, and the sterling against the dollar 1.30, higher by a little bit more than 0.7% this Friday evening. I want to have a very quick look at European indices. It's been quite a great trading session here in Europe after the all-time record highs for the US indices. Stoxx 600 closed 490 points, and let me tell you guys that this 0.2% higher on Friday was a complete record for the pan-European index. On the other side, I want to show you the single European stocks indices. The German DAX 0.3% higher, the CAC 0.1% higher. FTSE MIP was the only one that traded below the flat line, actually 0.6% below the flat line, but just let me point out that FTSE MIP is the 6th best performing index for 2019, and we're also going to discuss this because it's pretty interesting. Great performers for the year for the Italian stock exchange. I want to show you very quickly FTSE 100, 0.2% higher this evening. Certainly it's going to be very, very observed this year. Considering what is going on with the Brexit, that's for sure an extremely important story. I want to focus now on the retail sector, in particular Amazon and Tiffany. Let me just show you very quickly the stock here. This Amazon 1.12 higher this evening. Actually, the first post-Christmas readings from the holiday shopping season suggest consumer spend at a healthy clip, as Amazon said online orders hit a new high and Tiffany reported an increase in overall sales. Industry consultants have predicted decent holiday retail sales buoyed by a robust U.S. economic and low unemployment. Online sales rose 18.8% from November the 1st through Christmas Eve, compared with growth of 1.2% for in-store sales, according to MasterCard Spending Pulse. Amazon described the 2019 holiday season as a record-breaking for the company, saying billions of items were ordered on the site and tens of millions of Amazon devices were purchased worldwide. The news lifted Amazon shares 4.5% just in 3 days. This is incredible. Tiffany, on the other side, said total sales rose for the holiday shopping season despite challenges in Hong Kong and Japan. The jeweler said global sales rose about 1% to 3% from November the 1st through Christmas Eve compared with the same stretch last year. So we can conclude that it's been quite a great holiday season for the retail stocks, and of course we're going to have a look at each and one of them in the second and the third part of the show. But as you very well know from our programming, that fintech is in the limelight, in particular open banking. So let me bring to the show my first guest this evening, Fabrizio Villani, co-founder and head of growth Fintastico. Good evening, and thank you so much for joining us.
Thank you for the invitation. It's a pleasure to be here tonight.
Actually, welcome back to the show, I shall say, because we were together already at the second episode of Global FinTech, focused on open banking. So here we are now, and I just want to know your perception and your understanding of open banking.
Yes, so open banking, as all the people should know right now, is already a revolution in the traditional banking sector, because more or less it should be the end of the monopoly of banks on the financial data of their customers. And of course there are different regulations in the market, the PSD2 and also the open banking regulation in the United Kingdom that started in 2018. And basically, thanks to the introduction of APIs, application programming interface, they allow the interchange of information between the customers' data and also third-party providers. So it's no longer like the ownership of the banks on the customer financial data, but these data now are back in the ownership of their customers.
And I mean, we're going to be back on regulation, that's for
Yes.
sure, because it's something very interesting. But in terms of API, how important is it for the sector? I mean, we saw many technological disruptions coming together with the open banking. Can you highlight the most important of them? And of course, explain to us, teach us, which are the different types of API?
So first of all, API, application programming interface, are pieces of software that allow two different platforms to communicate between each others in a secure way. There are mainly three different kind of API: private, public, and partner and open API. The private one is an API that allows different departments or silos in a bank or in a financial institution to communicate between each others, because usually they don't communicate because of legacy system and hierarchy and so on and so forth. Then we have the partner API. It's API made for an external partner of a bank in order to share information in a secure way. And then there are the open API, and this is the main point, because the open API allow communication with third-party providers. And actually the regulation, like the PSD2 and the open banking regulation in UK, they state that banks must open up their data, their financial data, habits, and also transactional data with the consent of the customers with third-party providers. That, for instance, these third-party providers, they can be fintech company or also the big tech. I think here with regards to Apple, Amazon, and so on and so forth.
And I was wondering, how are consumers reacting on this opening of their data? Because you know that you've just mentioned a few of the FANGs, and there were many privacy scandals regarding these FANGs. Of course, there is a regulation that is supposed to ensure the data of the customers and clients of the different banks and so on, and financial institutions, whatever they are. But I mean, how are customers reacting? Do you have any insights, let's say, like that?
Yes, from my point of view, customers are a little bit afraid about this opening up of data, but unfortunately the regular man on the street, they don't know really well about this kind of regulation and this kind of innovation. So it's like the introduction of GDPR in Europe, where all the people are just flagging checks without reading all the condition. We are lucky because, especially in Italy, with Bank of Italy and also Consob, the Italian Financial Conduct Authority, they are quite stringent with regulation, and they are checking out fintech companies, bank companies, and so on, in order to check if they are applying in the correct way the regulation. So a bank can share financial data of their customer only with another company, only if the customer accepts, state that they want to share this data with a third-party providers. So, for instance, I already use an e-commerce website that I really like a lot and I trust a lot. Then, if I receive a notification where this e-commerce asks me, "Hey, do you want to share with me all your financial history in order to receive a better service or a better overview on your financial health?" Well, why not? I mean, I have this opportunity to share in order to receive a better customer experience and a better service.
No, I'm asking because exactly you said they're just clicking without reading, but how would you read, how could you read like 12 to 13 pages? That's like a little bit of hard work in your everyday life, since you're pretty busy. That's the only concern.
It is, and you are completely right, but this problem, we are already facing this problem every time that we sign up for a new banking or service product, because almost no one is reading 40 pages with technical language, where at page 16, line 10, you have a strange hidden commission that you discover in 1 year time. So we are going back to trust and transparency. So with fintech, with this fintech revolution after the financial crisis of 2007, 2008, all the stakeholders in the market are more focused on transparency and trust. Banks were eaten quite hard on the trust side, and they are having difficult times in competing with fintech because of transparency. Transparency means that when I click OK, agree, let's do this operation, before I click this button, I know already the cost structure and I have no surprise. So if the fintech is charging me €10, I'm sure that are just €10 and I will not have any surprise in the future. While with other players in the market, we know that it's not like this.
Well, let's talk about regulation.
Yes.
First of all, how much of a help it has been so far, especially the PSD2, and do you think there are some gaps that might be fulfilled in order to, how can I say, to support the open banking and also the fintech as a whole, the fintech structure as a whole?
Well, with regards to PSD2, I believe it's a good beginning, but it's not the end of this process of changing the banking sector. Another piece, and eventually we will have it before the end of the year in Italy or in January, it's going to be the sandbox. Sandbox is an environment where regulators sit together with innovative financial companies, and within 18 to 24 months, the fintech companies have the opportunity to test their product or their service together with the regulator. This is already an approach that was used by UK with I would say great results, because we all know that UK, thanks to the fintech sector, is creating a lot of jobs and receiving a lot of investments. And nowadays in the economy, we are all focusing on creating jobs and expectation to the future and investments. So if Sandbox can be a great way to create jobs and also attract investments to Italy, why we should not try also to have this sandbox environment where fintech companies can collaborate with regulators and improve the whole system?
And how can I say, rate the European countries in terms of fintech developments? Because certainly, I mean, I believe it's not a secret for anybody, the UK is the best so far, correct me if I'm mistaken. But how would you compare, for instance, since you are Italian, but at the same time you work and also lived in Barcelona, so you have your insights and, of course, information for stats. How would you compare them in terms of fintech, and how are the two countries developing in this sector?
Well, for all the people that are listening right now, this television, I would suggest to check out the EI Fintech Adoption Index. Is an index that allows people, consumers, regulators to compare the different countries and how they are adopting fintech. And if we check the latest one for this year, we find out that Italy is 51% fintech adoption in comparison to Spain, 54%. For instance, China has over 80% of fintech adoption, and same for UK.
In the US, just out of curiosity?
US, I think it's over 65%. And
so behind China?
Behind China, yes. Because in China we have not only the share of banking, that this is another topic, but also because they are more rely on apps and platform instead of the regular banking sector. And so in a country where there is a weak banking sector, then fintech can grow really fast. But we also notice in UK that in the latest 20 years the Bank of England gave out a lot of banking license, and these allow a lot of private companies to create famous or at least to me famous challenger banks that have startup that have a banking license without physical branches and without the same amount of employees that have a traditional bank, that are challenging the status quo of the banking sector, especially in UK or United States. So we're living in interesting times.
Absolutely, but I was wondering, do you consider the fintech banks and the fintech as a whole a competitor, an opponent to the traditional retail bank? Do you think they can coexist together? We saw many examples of successful coexistence, but in general, retail banks are not very happy with the fintech banks, let's call it like that.
Yeah, well, I started in the fintech sector in 2013, and in 2013 the environment was different. We were all talking about competition, so compete on some topics and cooperate in some other with traditional banks, between fintech and traditional banks or retail banks. While nowadays, I believe traditional banks or retail banks need fintech because the enemy, the winter is coming, and in this case, winter are the big techs, because Apple, Samsung, the GAFA company, they have the trust, they have the technology, and they have the human capital. And back to the point that, I'm living and working in Barcelona, I had the opportunity to talk with one head of mobile of one of the biggest banks in Spain, and they ask you like, hey, but why are you happy every time that you launch like a new collaboration with Samsung Pay, Apple Pay, and so on and so forth? I mean, I don't understand. I think they are like potentially they are stealing in the future your clients. You shouldn't be happy. And he replied to me like, well, in my department we have 18 people. I had the opportunity to travel to South Korea, and Samsung, just for Samsung Pay, they have 1,000 employees. So
wow.
These just explain how banks are having difficult times in order to compete with big tech. So they need some allies, and eventually fintech, because of their innovative proposition, can be also a good ally for banks.
And how would you explain the fact that the Italian banks are relying mostly, how can I say, on third parties like software API, software providers? They are
Yes.
not launching their own programs. How would you explain that? Is it a question of lack of money to, how can I say, develop this, or it's just a choice?
Well, yes, this is a good question. Actually, in Spain, for instance, I noticed that BBVA, they developed their own API market where developers can play, let's say, or can create a new website and apps thanks to APIs that BBVA explain or share with these developers. While some other countries, like Italy, I saw some banks that are developing their developer portals, but they're not, let's say, proactive, and they tend to rely to some other companies that are more or less involved with the banking sector. So my fear as an Italian is that this approach is not too much innovative in comparison to other countries, and because you rely in some other companies that are not really innovative, and they don't have any reason to really innovate, to push the limit. So I think the answer to your question is because we are more risk adverse. Italian, usually we are risk adverse. We tend just to rely or to trust our inner circle, usually our family, and these sometimes can be a problem also with new technologies, because we prefer to wait and check if this new technology will grow or disappear in a few years.
All right. So I was wondering, after open banking and all the other topics regarding the fintech, which is going to be the next disruptor, because you guys are bringing the latest in terms of fintech. Of course, I'm talking about Fintastico, the company that you're working for, and also your co-founder.
Yes.
So since you are occupied with exactly bringing us the latest and bringing up the latest innovations, and what is coming up next? What's coming up next?
Good question. Unfortunately, also in Fintastico, we don't have the crystal ball. We are lucky.
You don't have the crystal ball.
No, not yet. But we are lucky because we are discussing with a lot of fintech, not only Italian but also international, that are looking into the Italian market as an interesting market to enter, because of the position of the traditional banks that are not so innovative. So fintech see the Italian market as an opportunity, but I would rely on other sources of information, like the Economist Intelligence Unit in a survey found out that 36% of retail bankers are believing that machine learning, artificial intelligence, and blockchain are the technologies that will have the biggest impact in the short-term time. I agree, even if I have some doubt on blockchain technology, because blockchain technology, they still don't have a standard. So there are different blockchain technologies that are competing between each others, and so this can slower the development of blockchain as a standard to the whole industry.
And when are we going to see the fintech literally explode? Because it's been boosted, let's say, but we're still waiting it to explode. When is this going to happen?
Unfortunately, for this question, my answer would be, let's wait for the next financial crisis. Hopefully the next financial crisis will not start from inside the banking sector, but if also this time will start inside the banking sector, consumers and companies will lose again the trust in banks, and then eventually rely more and more on alternative fintech companies, because at the end of the day, fintech is the growing of alternative finance. in comparison to traditional finance that is not so well digitalized.
All right. Thank you very much. Fabrizio Villani,
It was a pleasure.
co-founder, Fantastico, and head of growth. Thank you so much for joining us, and have a happy holidays and have a happy new year.
Thank you a lot. Same for you. Bye.
Well, we're heading for a very short commercial break, but stick around, guys, because after the break, I'm going to show you a chart, but very interesting chart. Good evening, everybody, and welcome back to Fonti International. This is our second part of the show, and we're going to analyze the losers and the winners so far for 2019 and what to expect from 2020. Certainly, it's going to be very interesting, so you better stick around. But first of all, very quick look at the US indices so far. S&P 500, 3,242 points. Dow on the other side, 0.2% higher. NASDAQ Composite pretty flat, but still have a look at these figures. 9,080 level, 18 level. This is really an incredible historic high for the NASDAQ Composite. On the other side, very quick look also at the FANGs. Most of them are down today, except Amazon, which had a great year, and it looks like it's going to have even greater year in 2020. So far, $1,885,000 per share, higher by almost 0.9%. And let me tell you something, it reported together with Tiffany, great holiday season for the retail sector. Actually, I shall point out that during the holiday season, the retail sector jumped by 14%, and we know that a holiday season is around 1 month. On the other side, very interesting stock to watch certainly is Tesla. We're going to discuss the stock a little bit later on the show, but have a look at the figures. $430 per share, pretty flat this evening, but still we saw major rally for Tesla in the last few days. Very quick look also at the bond market. The US 10-year is yielding 1.87, the 2-year 1.59, and the 3-month 1.57. On the other side, the very quick look also at the Forex, the dollar index 96.97, euro dollar 1.11, and the sterling against the dollar 1.30, 0.8% higher this evening. So as we can see, there are a little bit of movements over there on the Forex exchange. Certainly, we're going to be back on the markets, but first of all, very quick look at the major headlines. The tech-heavy Nasdaq about to close the year, topping the historic 9,000 mark, lifted by a jump in Amazon shares on a record holiday shopping season. China warns European Union not to implement protectionist policies if Brussels enacts tariffs. Consequences will be catastrophic. European Commission President Ursula von der Leyen voices her concerns about Brexit. 1 year of negotiations could not be enough to hammer out an effective agreement between the two parties. US electric vehicle maker Tesla will begin delivering Model 3 vehicles built at the Shanghai factory on Monday. The stock is hitting all-time record highs. 1 in 10 zero on the markets draws to a close at Fonti International. We will analyze the winners and the losers of 2019 and what to expect from 2020. Certainly, it's going to be a very interesting show ahead of us, so you guys better stick around with us. But first of all, before we go ahead, I want to bring you an extremely important story, and it's something that is going to be very important for 2020. And of course, it's the Brexit deal and the possible agreement between the EU and the UK. Actually, Boris Johnson should reconsider his refusal to extend the 11-month time frame available for agreeing a deal on the UK's future relationship with the EU after Brexit. Ursula von der Leyen has suggested earlier today. The European Commission President said she had serious concern about a limited time available for the negotiations and emphasized the need to keep all options open. It's not only about negotiating a free trade deal, but many other subjects, von der Leyen said in an interview with a French newspaper, Les Echos. It seems to me that on both sides we must ask ourselves seriously if all these negotiations are feasible in such a short time. Once the UK leaves the European Union on 31st January, it will remain the bloc's customs union and singles market unit the end of 2020, with an option to stay within those agreements for a further 2 years. The question is certainly very important, that's for sure, with a huge impact on EU economy, the UK economy, and of course the Forex market, which is so favorite to you, to all our viewers. In order to go ahead, of course, with the show, let me bring to the show my next guest this evening, Daniel Gramza, President at Gramza Capital Management. Good evening, Dan, and thank you so much for joining us.
It is my pleasure to be with you.
Dan, I would like to start with the US indices because it's incredible. I had such a short holiday, and I do find even higher figures, higher numbers. It looks like they have never slept. Markets never slept. So S&P 500 is 3,242 points, but what is remarkable is really the figures of NASDAQ, 9,018. Is this something that surprised you, or you rather expected that kind of numbers?
Well, I'm still looking for a stronger close as we finish this year out. I think there's a few things driving this. One, the numbers support it. The economic numbers still look healthy. Our unemployment's still down. Inflation is still under control. We have a Fed that's accommodative. And so that permeates the market. It permeates how people feel about the market, their confidence in the market. So I think today will be interesting. Friday is a barometer of confidence as we go into the weekend. So are people willing to hold long positions in the US stock market as we go into this weekend? Or do we see selling come in before the market closes, which implies that people need to back away a little bit before this weekend, because the market doesn't trade on Saturday. The futures market begin to trade 5 o'clock Chicago time Sunday night, which is Monday morning in Asia. So it's a barometer of how confident people are on Fridays. But even if we see that, I'm still looking for a stronger close as we go into year end. A few things we want to keep in mind is that mutual fund or fund managers will also do what's called window dressing. So if there are certain stocks they do not have in their portfolio that are moving well, they will add those stocks before the end of the year. That also can put some upward pressure on the stock market. So I'm comfortable with what we're seeing, and I'm still looking for strength next week as we go into year end.
Dan, let me show you, and of course also to our viewers, a table or a chart, we can call it as you prefer, very interesting one. I just wanted to show to everyone the worst and the best performing sectors for S&P 500 for 2019 so far. Of course, the first one is the technology, the information technology. The second one, communication services, utilities, real estate. The fifth one, industrials, together with financials. And not surprisingly, the last one is the energy sector. We know that the energy giants, the US energy giants, lost more than $20 billion of market cap throughout 2019, and this is a big figure, big amount of money. Dan, you know what I was wondering, do you expect any, how can I say, any change inside of this table of contents that I'm showing to our viewers? I mean, for instance, is the tech gonna be the first one also for 2020?
I would look for two areas. One, I do think technology is going to stay strong in 2020. We've seen so many innovations this past year, and I believe that's going to continue going forward. The other area that I expect to get stronger that's not on your list is healthcare. That sector, I think, has the potential for getting stronger as we go into next year.
It is, actually. It is in the list. It's around the bottom.
Okay. Well, I'm looking for that to get stronger as we move up. I can't see your list, but I think that's one, a company CERN and AMGN, not recommending these stocks, but these are ones that I think may lead that sector as we go into next year. So I think it's logical what we're seeing. If you look at the energy market, where we're seeing that weakness that you're talking about, I'm just not bullish on the energy sector. I really still feel that there's plenty of supply out there. And even though we're seeing some stronger crude oil prices, I still have my doubts about its sustainability to maintain this upward momentum.
Exactly. You've just mentioned that we have some higher oil prices over there. I'm going to be back on the table of contents, but first of all, I wanted to ask you your comment exactly on the higher oil prices. Do you think they are thanks to the output cuts that we saw from OPEC?
No, I really, if you look at the global supply of crude oil, the big picture, we have plenty of crude oil out there. And right now, if we get this agreement with China finished, then the expectation is industrial output in China will continue to increase, and that would increase demand. So on a global basis, that may soak up some of this excess supply. But right now, I just don't think we have an issue here that is sustainable. Except one more thing, now that I think about it, what we should take into consideration is the US dollar. Now, if you look at the US dollar today, it is weaker. If you look at the euro and the Swissy and Aussie dollar, British pound, Canadian dollar, they're all stronger against the US dollar. And when the US dollar is weaker, that has a tendency to put upward pressure on the energy market. Because oil producing countries, they get paid in US dollars. And now they go to their bank to switch these US dollars to their currency, and they get less of their currency. So the way to offset that would be higher crude oil prices. So that may explain some of the upward pressure, but I just don't think that's sustainable. If the dollar comes back a bit stronger, I'm looking for some weakness in these energy prices.
That's very interesting. And now back to the table of contents. I was wondering, I don't know if you follow this sector, but what do you think about a real estate? So far, it's at the 4th place and the healthcare is at the 9th place. So you said already that you expect these movements regarding the healthcare, which is very interesting because it's going to be a major topic during certainly the US presidential campaigns, that's for sure. Most of the candidates are talking about it a lot. On the other side, you also pointed out that you expect that the technology is going to remain in the very first place. But what do you think about a real estate?
Well, I think we've seen some positive signs in the real estate market. If we think about the environment, first, we have low interest rates. So that helps fuel the cost for homeowners to now get a new home. We've also seen an increase in the amount of housing starts and housing permits, and that also fuels that real estate sector. And we've seen a consumer group, the US consumer, is willing to spend money. With these lower interest rates, they're feeling that they could lock in mortgages at favorable prices, and they have the disposable income now to spend. So we've seen wages go up a little bit. We're seeing consumers spend in the United States, and those are all positive things when it comes to the real estate market. We're seeing healthy signs of growth there. And when we look at the housing market in the United States, we also want to think about some other sectors that may have an impact here. If you look at, well, for example, copper. If you think about that, we use 400 to 600 pounds of copper typically in a U.S. new home. And so the demand for that product could also increase as we go forward. The related companies like Home Depot and other companies that supply the building industry, we could see some upward pressure in those markets as well too. So the real estate market, I think, right now has a healthy environment. There's also another area that I think we want to think about when it comes to real estate. In the United States, unfortunately, we've had some natural disasters, from forest fires to hurricanes, that have also, unfortunately, depleted a number of homes in our housing stock. Those homes are being rebuilt. And that also adds to that sector. So I think there's a few elements that have come together that increase that strength when it comes to the real estate sector. And I would not be surprised to see it hold this level, if not increase, as we go into 2020.
And talking about copper, what is the outlook for the commodities, but also like the gold? Because actually, many analysts were expecting higher prices for the gold this year. Still, it's doing a great job. I mean, I shall point out that it's trading so far above the 1,500 levels, but they were even higher predictions. What is your opinion regarding this precious metal?
Well, on the precious metal side, I've been neutral to positive on gold and silver. I don't think there's anything out there that's bearish for these markets, but I really didn't see anything super positive. However, now that was my outlook, but we are seeing buyers coming into both of these markets. And so then you wonder, who is this? Is it people that feel concerned about the high stock market prices and now they're using precious metals as a hedge? So they want to take some of their capital, not only leave it in the stock market, but maybe put some in precious metals just in case things do turn down. That may be some of the action that we're seeing here. I think what's also important, we've seen the strength come into the gold and silver markets over the last, 2 to 3 days. But now, will it maintain this momentum? And there I have some doubts. Could we go higher? Absolutely. But do we have the reasons to continue to fuel that market moving higher? So I'm cautious on the long side for the precious metals. It'll be interesting to see how they develop.
And on the other side, I want to get back to the currencies because there are many interesting things over there. For instance, dollar index lower by 0.6% this evening, 96.98. Euro dollar higher on the other side as a consequence, 1.1178 by more than 0.7% together with the sterling against the dollar, 1.38% higher. As you mentioned very well, that we do witness extremely accommodative central banks. Also, the Federal Reserve has become one, an extremely accommodative central bank. So what's the outlook for the dollar index? Do you think it's going to be overbought also in 2020, or you expect different scenarios?
Well, actually, I was looking for a different scenario. And right now, what I was expecting going into year end was a strengthening in the US dollar. And that is not what we're seeing just today, in fact. US dollar is weaker, as you mentioned. This 96.50 is going to be an important level for that market. If you look at the history of that particular index, we've seen buyers coming in at this level over the last few months. So it'll be interesting to see how it behaves at a critical level, this 96.50, as we go forward into 2020. If we think about the other currencies, you mentioned what was happening with Brexit. Does the market finally feel relief that there may actually be an outcome? Whether it's a good outcome or a bad outcome on Brexit, that's to be determined, but the fact is there's an outcome. And is that part of what we're seeing fueling the moves that we're seeing in the euro, in the British pound, for example? Is that what's driving that marketplace? So right now, maybe for this first quarter, the dollar may indeed stay weaker. I was expecting it to get stronger because our stock market is so strong. If I'm a money manager sitting in Italy and I'm looking where to put some of my capital, the United States may be a stock market I want to participate in. So I got to take my euros and turn them into US dollars to participate. And that's where I thought we'd see some buying pressure into the US dollar. Right now, that is not materializing, and we are seeing two things: that weaker US dollar prices, it's approaching a level that we want to pay attention to. So it's going to be very interesting, I think, to see what happens over just the next few weeks. Do we indeed see that weakness in the US dollar? Again, it's not what I was looking for, but that is indeed what the market's doing.
All right. Thank you very much, Daniel Gramza, President Gramza Capital Management. Thank you so much for joining us, and have a happy new year, Dan.
Well, thank you very much. The same to you and to our viewers. It's always great to be with you, and I'm looking forward to being with you again next year.
Absolutely. We're going to be together in the new year, that's for sure. Thank you very much once again. Well, let's get back to the US indices once again to have a very quick look at what's going on there. Actually, I shall point out that stocks notched fresh record highs few hours ago, actually, after year-end, optimism continued to drive the rally. This is incredible. S&P 500, 3,241 points, 0.04% higher. Dow on the other side, 0.2% higher. And Nasdaq Composite down by 0.14%, but still 9,009 points. Let's see if what is going to be the closure for Nasdaq in 2020 and how it's going to start the 2020. That's for sure something very interesting. But let me bring to the show my next guest this evening, Sante Pellegrino, CEO of SantePTrader.com. Good evening, Sante, and thank you so much for joining us.
Good evening to you, and thank you for the guests.
Sante, I was wondering, I was showing to our viewers a table of contents with the best performing sectors so far for 2019. At the first place is, of course, the technology. The second is communication services. The third is utilities. And the last one, the 11th one, I'm talking about S&P 500, 11th sector, is energy. I don't know if you see the table of contents, but certainly it's very interesting for our viewers to outline, to highlight what kind of changes do you expect inside within this table of contents.
Okay, this is really interesting because the technology is the big actor of the 2059. This is really important because technology and communication is really connected and are really linked. And for this is a really big conquest to create the pole position, the first charts and second post in the charts. I think it's more important, but to observe the commodities. It's not the energies or the commodities, it's not in the last position, but it's only in the freeze mode. Is only a laterally trend situation because we have a diversification of portfolio by institutional trader. This diversification is important because the price of the best commodities, crude oil, it's not good in the last year because have some problems about the new concept of energy sector, about car with the blue car, with the electric car. This is really important, and for this the price of crude oil is more deep than the past years ago. But it's more important to observe that the influence of the dollar, strong dollar, have a great influence of the oil price because we have just the euro and the other antagonist currency in the deep of the trend in currency. And for this, energy sector and the commodity sector is no good, is in the last position. But in the next year, I think it's more important to observe who is the final rush in the political in USA. In the last year, Trump confirmed the strong power that he have blinded all USA country, and don't want to create a trade with China or with Russia or with other countries that don't have more power interesting in the USA. For this, USA is the first consumer in this year, and it's important to have a new observation in the new year. In the 2020, I think the market, the financial market, can go up if Trump win in another time, but it's not more possible this. If Trump don't win the next political election, it's more possible that the financial market have a lateral trend, because we have to all 20,050, the VIX, the volatility index, in the minimum part of the charts. We have a deep market in the volatility index. This is more interesting because create a lateral trend in the next year if the VIX go up and create a new trend in an up charts. This is my personal opinion on the financial market and on the volatility in the next year. And I think it's more important to attempt the results of political election. This is the market mover in the next year.
So this is the key market mover. You know, I was wondering very quickly, what do you think about the tech sector? Because it's at the very first position, followed by communication services. Do you think these two, how can I say, sectors are going to remain over there at the first two positions also in 2020? And also, you've just mentioned a few seconds ago that the energy sector is going to go higher in this positioning. How much higher do you expect it to go?
I think that the tech and the communication segment is more important, but in the next year I don't think they can remain in the first chart or the second position of charts. I think the tech index and the communication can have a little bit positive trend. Energy sector, I think, can have a good approach in the next year because can have a good gain if the Federal Reserve is more accommodation with a strong dollar. If dollar not be strong in the next year, I think the euro, the pounds, and the yen can go up. And if this currency go up, the commodities, and especially the crude oil, can go up. And for this, energy sector can have a new rally in the next year. But it's really important to remain focused on the next election. It's really important.
All right, thank you very much, Santa Pellegrino, CEO of SantaBTrader.com. Thank you for joining us and have a happy new year.
Thank you too. Have a happy new year to you.
Well, we're heading for a very short commercial break, but stick around, guys, because in the next part of the show, we're going to comment the two major stories of the day, and not only we're going to continue with our markets for 2020. Welcome back to Fonti International. This is our third part of the show. Very quick look at the US indices so far. S&P 500 is 0.03% higher, actually 3,000 points, 241. Dow on the other side, a little bit more than 0.1% higher. Nasdaq Composite 0.2% lower, but still 9,000, trading above the 9,000 level. More precisely, 9,005. We're going to be back on the markets, but first of all, very quick look at the major headlines. The tech-heavy Nasdaq about to close the year, topping the historic 9,000 mark, lifted by a jump in Amazon shares in a record holiday shopping season. China warns the European Union not to implement protectionist policies if Brussels enact tariffs. Consequences will be catastrophic. European Commission President Ursula von der Leyen voices her concerns about Brexit. 1 year of negotiations could not be enough to hammer out an effective agreement between the two parties. US electric vehicle maker Tesla will begin delivering Model 3 vehicles built at its Shanghai factory on Monday. The stock is hitting new all-time record highs. One intense year on the markets show to a close at Fonti International. We will analyze the winners and the losers of 2019 and what to expect from 2020. Certainly, it's going to be very interesting. As we were talking with my previous guest on the show, the key topic, the key market mover is going to be the US presidential elections. That's for sure, no doubt about it. We're going to discuss each and every detail of it when the time comes, of course. But first of all, I want to start with what's going on here in Europe, because it's going to have a huge impact on the EU economy and also the UK economy, of course, after what Ursula von der Leyen said earlier today. Boris Johnson should reconsider his refusal to extend the 11-month time frame available for agreeing a deal on the UK's future relationship with the EU. After Brexit, Ursula von der Leyen has suggested. The European Commission President said she has serious concern about the limited time available for the negotiations and emphasized the need to keep all options open. It's not only about negotiating a free trade deal, but many other subjects. Von der Leyen said in an interview with a French newspaper, Les Echos, "It seems to me that on both sides we must ask ourselves seriously if all these negotiations are feasible in such a short time." Certainly, as I said, how it's going to happen, the divorce between the European Union and the United Kingdom is going to be an important market mover, at least here in Europe, and especially regarding the forex market and the movements of the sterling. It's been one of the most volatile currencies throughout 2019, that's for sure. So very interesting times are about to come. But in order to go ahead, let me bring to the show my next guest this evening, John Ergas, Chief Economist, Tigers Financial Partners. Good evening, John, and thank you for joining us.
Good evening, Alexandra. It's always a pleasure, always a great honor. Thank you.
Jean, I just wanted your very brief comment on the topic. Do you think that these guys are gonna manage to find a good deal, a good agreement, a sufficient agreement within 11 months, which is very limited period of time?
No, I don't think they will, for two very simple reasons. First, trade is extremely complex. Trade is very granular. Trade is very detailed. If you look at trade agreements run to thousands of pages, if you look at how long it took the EU and Canada to negotiate a fairly simple trade agreement, which was simply goods, which excludes services for the most part, if I'm not mistaken, but very basic agreement, it took them 7 years. Now, well, you can accelerate it. Yes, what are you going to get out of it? We can accelerate it. We can do it in 5 minutes. And we'll simply have a piece of paper, which will not be worth, as paper, so to speak. But I think it's going to be very tough. I think what people do not underestimate or do not understand is the fact that Johnson basically does not care. If he really cared about having a great trade agreement with the EU, he would say, you know what, let's give it a bit more than a year, but work out something really good together. He says, no, he says, look, I've given this a year. This is what my time span is. Now, if we get something, fine. If we don't get something, that's fine too. But in any case, going forward, the EU will be one of several reference points. It will not be the reference point. I think the big difference between May and Johnson, the main point of leaving the EU was to basically stay in the EU under EU light, structured, synthetic EU relationship. This man says, no, I am leaving. It is not a formal, it is a substantive act, and I want to break with 46 years, I remember it's 1973, 46 years of UK history, reverse it and go back to UK, which is which trades on its own, which is a power in its own right, and will be equidistant from all of its trading partners officially, and will be free to strike deals with them. So that makes me very tough. I think people should be very worried, quite frankly.
And talking about this point, actually, as I just mentioned a few seconds ago, the sterling has been one of the most volatile currencies throughout 2019. What is, in your opinion, the outlook regarding the sterling in 2020?
I mean, I'm going to give you an outlook 2-week basis. I mean, I don't think you can do more than that. First of all, I do not believe it is being driven in this moment by economic fundamentals, because the economic fundamentals in the UK are not great. Secondly, I believe it is being driven by politics. Politics are notoriously unpredictable, arbitrary, and irrational. And I think that basically I would not be trying to trade sterling. I think it is a mug's game, as they say in Britain. I think you will get squashed. I think the big banks are trading it. Some are losing money, some are making money. Don't try to catch the swings in the cable, because in any case, the question about sterling is this: sterling is a developed market currency which trades like an emerging market currency. It trades on politics, and it trades right now on very large capital flows, which could be companies exiting the UK, selling sterling assets, so on and so forth. So it's going to be very sort of batch transition and bumpy, this whole business right now. So I would not do it. I don't think sterling has a huge future in the next months or so, quite frankly. I would not trade it. I would not take the risk on 3-4%. I can see an upside to maybe 134, 135. I don't see much more than that at this point.
Well,
if there is an upside, if there is an upside.
134, 35 sounds pretty good.
Well, look, I mean, it went to 135 before, it then went down below 130. So, I mean, you're looking at a lot of volatility here. And my feeling is it went to 135 and came back to below 130. And the only reason it's above 130 is the dollar is slightly weaker, is because people have not simply taken profits, but they've shifted their stance. This is why there's concern. So I would not risk my neck. I mean, on this, I think you should risk your neck elsewhere if you wish to risk your neck and have better fundamentals, but I would not risk my neck. I do not believe the British government has a vested interest in having a very strong sterling rate, not if I want to sign trade agreements with the whole world. I want a relatively cheap currency so that I can compete well, not an expensive currency so nobody can afford my goods. Remember, the problem in the UK is the productivity. Productivity growth has been very low. Productivity in the UK is not high, and therefore you have to be able to compete on price, and that includes also what? Low currency, devaluation, because you're not going to make it up on increased productivity on the factory floor. So I think I'm not a huge sterling bull. I think probably there could be better places to put your money if you're willing to take that kind of risk, and you're going to get a better risk-return ratio, which I think is what we're talking about here. I think the UK will stumble through. I think there will be a lot more ups and downs. There will be a lot of rumor. There'll be a lot of trading around rumors, and I would strongly dissuade people from trying to make their fortune trading around rumors.
Well, that's certainly very interesting. We're going to follow the movements of the currency markets, that's for sure. Let me bring you another very interesting story today. Actually, this time it's not China versus the US, but China versus the European Union. Beijing's envoy to the EU has warned the bloc against pursuing policies to curb Chinese companies' access to Europe, saying it would damage its own interests and deter investment. Zhang Ming said plans to clamp down on foreign corporate ownership, trade opportunities, and 5G mobile communications technology threatened to trigger a backlash from suspicious Chinese entrepreneurs. The ambassador, a veteran diplomat and previously a senior foreign ministry official in Beijing, said EU countries needed to promote international cooperation in free markets, otherwise it's disastrous for them, he warned in an interview. How do you interpret this warning coming from China versus the European Union?
I think there's 2 points. The first is that Chinese capitalism has been expansionist. Chinese capitalism has focused on extending the reach, let's put it this way, it's reach along the value chain. So they want to control as many parts of the value chain as they can now. That includes maybe also point of sale or production in certain countries for a higher value added part of their product. And it's political. I think it's very, very important to understand that this discussion must be seen in terms of the Belt and Road Initiative, if I'm not mistaken, in trying to gain a long-term foothold in Europe and trying to make political allies out of economic partners. Now, there's another issue, and that's very risky. And we saw.
Well, we have some problems with the line. We're going to try to reestablish the connection. Jean, are you there?
I am here. Absolutely. I hear you very well.
All right, because
I can hear you.
we had some problems on the line. Go ahead.
Okay, I hear you very well. No, I think so. All I'm saying is basically this is that it's political. People are wary. The EU is wary. The EU does not want China to use the EU as a bridgehead to then infiltrate, I know, via technology, the Huawei story, the 5G story. So I think that's basically what it's about. I mean, and now for the first time, China comes up against an adversary which is mercantilist like it is, which basically unites state and economy together like they do. And they're going to have a very hard going time here. You know, they're not just beating up people who live in free market economies. This is really about two states colliding. One state, I would call it a structured state, which is the EU, a virtual state. And the other one is China. So I think it's going to be very interesting. And I really do not believe that the EU desperately needs Chinese investment. There's a lot of investment flow into the EU anyways, and if the Chinese invest there in certain sectors or not, it's not the end of the world. And let's face it, they also don't want it to be competing with industries. This is the Europeans who receive massive state subsidies when their industries cannot. This is simply going to create an unfair playing field. So I think it's going to be a battle of the titans here, and I don't think it's going to be resolved easily. But the fact that Chinese investment does not flow into Europe, to my mind, the game in Europe.
Well, certainly that's very interesting, John. Let's get to the market's outlook, because certainly
Sure.
That's the momentum, the right momentum at the
Sure.
end of the year. I just wanted to show something to our viewers. I don't know if you can see the chart, actually the table that I'm showing, but I just wanted to point out that the winners and the losers. This is a table showing the winners and the losers, and so far at the very first place is, of course, the S&P 500 technology sector, up by 48%, Nasdaq 100 38% higher, together with Nasdaq Composite 36% higher. But there is something remarkable, and I want to show to our viewers. It's the FTSE MIB, the Italian FTSE MIB, up by 30.4% for the year. Well, that's a milestone, no doubt about it, for the Italian stock exchange. Jean, do you think the performance of FTSE MIB reflects the Italian economy?
I think performance of FTSE MIB reflects two things. First of all, that many investors were underallocated to Europe in general, and they were underallocated within their underallocation. They were underallocated to Italy, which they saw as being something specific, as being apart basically from the other countries and having problems of its own. They have since made up for this underallocation, and I think that's basically it at this point. They are now saying, I am balanced. What I think they're looking at is saying, look, there's the Italian economy, which is one thing, and there is basically the Italian companies. Let us see which companies are based in Italy potentially, and which also have substantial cash flow abroad, and which therefore are insulated. I think the big misunderstanding a lot of people have when they say the French stock market, the British stock market, the German stock market. Very often the stock market investor in certain companies is not investing in that country, but is investing in an entity domiciled in the country, which derives a large part of its cash flow and earnings from abroad, and therefore is a conduit and not a representative of the country in which it is domiciled. I think it's basically it. I think people have ruled out now for the time being that Italy is going to default. There was a very big default risk. And let's all remember something else when we say what happened in the space of a year. It was like they say here, oh, but look, the S&P did 29 or 25%. Yes, but it had dropped 20%, in 3 months earlier. So if you have to look at performance from trough to peak, but the trough was before Christmas. The year on year, I think, is very, very, very deceiving. This is basically it. I think Europe will stumble along. Europe will not be great. Growth rates will be low. Individual companies can do relatively well. I think this is basically the story. I think FTSE MIB, I hope Italy turns around. I think it's going to be very tough slogging for the economy as a whole, but there can be interesting situations even in economies which are depressed.
Absolutely, and I believe the Italian economy in Italy is an example for this, because the sixth position is pretty decent, I shall say.
Sure.
On the other side, let's talk about economic outlook, because it's extremely interesting year ahead of us, that's for sure. From one side, we do witness very extremely accommodative central banks, both the
Sure.
European Central Bank, also, of course, the Federal Reserve. So far, it got 3 times raised for 2019. What is your opinion? regarding the U.S. economy. I want to start with the U.S. economy first of all, because you know why I'm asking? Because
Sure.
earlier this year, during this summer, we were on air many times together, me and you, and of course I've been discussing with you this topic many times, especially when we had the momentum back in July of the inversion
Sure.
of the yield curve. So I've asked you many times, are we heading to recession? And you've answered, we cannot predict recession, it just happens. So far, I shall say that the range between, of course, the 2-year and the 10-year bonds, talking about, once again, I'm talking about it, the U.S. Treasuries, is getting higher. So did we, how can I say, did we manage to avoid recession?
I think, look, I look at it this way. I think the U.S. economy is doing reasonably well. The U.S. economy is being pushed along by the consumer. It's being pushed along by a new branch of consumers who are the ones who weren't consuming much before, but now they have a steady job, thank God, and they have a good income, reasonable income, so they can spend. The U.S. economy, I think, will do reasonably well in 2020. I think it will probably do slightly under less than 2% growth. I don't know if we're going to see the 3% growth spoken about by the Trump administration. It shall be an economy which is more similar to a department store than to an integrated economy with production and industrial investment. So I think it will do reasonably well. I think the great strength of the U.S. economy is that it can stand on its own. Like I said, the U.S. speaks global and acts domestic. The most important numbers that come out in the U.S. are not so much the earnings of the big macro corporates abroad. What really counts is what's happening internally in the country. And at this point, it's reasonable. And there's also very little systemic risk here. So I think it will do okay, quite frankly. I think the U.S. economy will do reasonably well. We're going to chug along. The 2s and the 10s, I wouldn't read too much into this because a recession can strike virtually any time. And it can come from a systemic shock type event nobody has actually seen, which is why you have to be allocated among different assets. But I think for the time being, I don't see a recession in the next 3 months, quite frankly. I think there could be a slowing. I think growth is slowing, but employment is strong. And so consumption will remain relatively robust. Because that's the only axis you have to look at in the U.S. right now. It's just the consumer. The consumer is fickle. Consumers can change their mind. For the time being, the consumers are spending. The consumers are now reflecting an economy which is based on income and going to the ATM or using debit cards and getting cash, rather than consumption, which is pushed or which is enabled for the very rich via quantitative easing and monetizing asset gains due to monetary policy. So I think we're looking at a very different paradigm now. The actual consumption push has been pushed down the ladder, which I think is positive, has broadened the consumption base, and we're going to be seeing some release of pent-up liquidity and pent-up buying. I think this will run a little bit longer.
And I was wondering, what is your opinion regarding the European economy? Because how can I say, the first one, the leader of the European economies, which is Germany, is suffering. We saw that. I mean, no doubt about it.
Sure.
Despite the fact there is some, how can I say, some positive points over there, some positive macro data over there, some light in the darkness, let's call it like that. What's the outlook for Europe?
Look, I think the outlook for Germany, let's talk about, you cannot speak about Europe without Germany. It's that Germany is a traditional center forward and the largest economy, and an economy which has extensive, let's put it this way, reach both domestically and abroad. I mean, look at the number of multinationals, look at the business with the emerging markets. I think Germany will stumble along. Germany will do maybe 0.5% growth, 1% within margin of error of recession. The German domestic economy remains relatively robust, unemployment remains low, and the construction sector is very important because now they're building a lot and this employs many people. As a going for, let's be looking at the broader European scene, I think we're going to be seeing relatively moderate growth. We're going to be seeing maybe 1% max. Nobody's thinking of anything more than that. I think Europe will manage to keep its head above water. I think Germany, you may be seeing a plateauing, a flattening out of the contraction industry, but I think that will take some time because it's structural and not cyclical. France is going to do all right because France is less exposed to the car sector, which is a big drag in Germany. Spain has already redefined its economic parameters some years ago. And then we're looking at, let's say, let us be bold, even looking at an England, okay? Europe because of the interchange, which I think will be a drag if we look at Europe ex-EU. So I think it'll be okay. I think it'll be all right. It will bumble along, and it's going to be helped along by monetary policy. And the important thing will be, and the game changer will be, if Lagarde can convince the ministries of finance to jump on the bandwagon, play doubles, and actually start pumping some money and disrupting the existing equilibria. I think it's basically, if not, it's going to be a steady state, slow growth, then slow recession, then very slow recovery for the next 10 years.
You know, Jean, there is also something very interesting. I'm back on the table that I was showing to our viewers a little bit earlier on the show. I shall say that the German DAX is well behind the FTSE MIB, but also it's behind the CAC of Paris, and of course many other S&P 500 sectors. Is this surprising for you, or rather not?
No, because I think, look, I think it's a factor, as we said. I mean, Germany is a very powerful economy, but the German economy at this point is not going very far. The German economy also depends a lot on exports. Exports have been slow. It has a very high sensitivity to exports. It is 50% of GDP is exports. A lot of these exports have been hit by structural factors such as cars. They've been hit by structural slowing, for example, in the emerging markets in relation to their capital investment programs, which are now ebbing after having gone through the first very expansive phase. So I think I'm not surprised at all. I think the problem of Germany is not a problem of solvency, it's a problem of growth, quite frankly. And I think that a lot of people are saying, you know what, it's going to take them time to figure out their problems. I'm going to keep waiting on the German market. Is the long haul? Let's look elsewhere. Let's look to see what could be still undervalued, what is still reflecting a systemic risk, which we believe has been reduced. Because the big problem in Europe was not so much the economy per se, but it was the fact that there could be a systemic shock through the banking system or through a default or through a hard exit, which could then imperil the whole construct. And people are saying, well, look, we think it's a bit less than it was before, and that's why the stock markets are rising. They're removing some of the systemic discount. So I'm not surprised at all. I don't see a bankruptcy risk in Germany on any of. I think these people have a ton of money. I worked there for many years. I was account manager and relationship man with some of the biggest German groups, and from the U.S. And I can assure you they have plenty of cash. Nobody's going. The big ones are not going broke anytime soon.
That's for sure. But still, it was very interesting the fact that actually DAX is up only by 26% compared to the FTSE MIB 30%, 30.4. And if we take into consideration the Italian economy and the German economy, that's pretty surprising. It kind of reflects actually the economic situation, because Italy, I shall say, hasn't been done worse compared to Germany this year.
No, it hasn't done worse. And I think something else I was saying before, which is this: when you look at sort of the relative performance, you have to remember two things. So the FTSE MIB, I mean, a year ago, people thought disaster was imminent. Maybe it is, maybe it is not. Now they see it is not, and so therefore they buy more. Also, you're looking at a smaller market. The float is lower, so it takes less to push up the prices. I'm very happy for the FTSE MIB. I think Italy, I think it's a very underappreciated economy in the sense that people tend to look at the government finances and equate them with the state of the corporate. Well, in fact, you have corporates that are exporting, that are doing very well. So I think that what we're seeing is a bit of a reduction in the discount, sovereign discount to the corporate valuations, which I think is very positive. Remember, there was a lot of money in Germany already, And then they said, you know what, I've got enough money in this market, and I've kept it there sort of as my anchor in the Eurozone, because I believe there's no solvency risk or no political risk here. Let me move my money around a bit. But it's still up 26%. You have to realize it's that simple. It's a much, much bigger pond. I think the FTSE MIB is, I think we'll come back. Like I said, there was a big, big drop in all markets at the beginning of the year around Christmas Eve. So we'll take it from there. But I think Italy will eventually will start turning around at some point. It will be relatively slow growth, but it will get there.
All right. Thank you very much. John Ergas, Chief Economist, Tigers Financial Partners. Thank you for joining us, and happy holidays and happy New Year, John.
Same to you, Alexandra. Thank you. Speak to you in the New Year. Cheers. Thanks.
Well, that was everything from us for this evening, but I want to warn you, don't miss our last episode of Le Fonti International on 30th of December. Stick around, guys, because we have many surprises for you.